Good morning, everyone. Thank you for joining us. It is really a pleasure to support you with our economic publication and with these webinars. Will be the last webinar before holidays, and we are going to talk about the economic outlook in this uncertain geopolitical situation. I'm pleased to introduce our today speakers, Seltem Iyigün, Marcos Carias, and Aroni Chaudhuri. They are going to touch Europe, Middle East, and Africa. And before I hand the mic to Marcos, I would like to remind to all of you that we are going to send the presentation, and also there will be a recorded version of our webinar. So thank you very much for your attention, and I give the floor to Marcos.
Thank you very much, Antonella. So I think it will not be news to anyone but just to remind us that the central fact, central event that has come to change expectations for the economy, for the global economy in this sort of the year is the Russian war in Ukraine. And to put it in a few words, the central effect this has had has been to make growth expectations, turn them from very good, which is what we were expecting before the war, to disappointing, essentially. So we were still having broadly expecting positive growth figures in all the major economies of the world in 2022, but these have been revised down from some very positive growth rates, very encouraging growth rates that we were expecting before the war broke out. We are already starting to see the effects that the inflation that is being provoked by this war is starting to have, even in Q1 GDP figures, most notably the American GDP figure, which contracted in Q1. We saw some figures that were pretty close to zero during Q1 in Europe. And on the other hand, an event that is a little bit separate but not independent, because it has effects on the supply chains, is the very hard lockdowns that we have been seeing in China related to their zero COVID strategy, which is also having inflationary effects, and which is also having us leading economists to revise down, quite importantly, their growth forecast for China. The word that best captures this overall outlook is stagflation, which is a portmanteau of stagnation and inflation, meaning that we have slowing growth and rising levels of prices. The main consequence of this stagflation from the policy-making side, from the side of central banks notably, is that central banks are now forced to make a more restrictive monetary policy in order to try to bring inflation under control. And this is a really radical change of paradigm after many years in which lending conditions, with financial conditions, in which interest rates were very low, lending conditions have been very accommodative. And so this is really a new normal, and there is a lot of uncertainty as to how the economy will be able to respond, will react under these higher interest rates, most notably in places like Europe, where debt, both public and private debt, is very high. It is also an important consequence of this is also the appreciation of the US dollar and the effect that this might have on many emerging economies that, as we know, when the dollar appreciates, it means that their currency depreciates. So they have more inflation through the products that they import, and they are also vulnerable to capital flows and capital flight. In this first part of the presentation, I'm going to try to take you very quickly through the outlook for the major growth engines of the global economy: the United States, China, and continental Europe. So the first thing that I would like to show to you are the revisions to our growth forecasts for the year 2022 that we have had to implement as a consequence of the war in Ukraine. So as you can see, this chart shows you the intensity of those revisions depending on the countries. And the first thing to notice is that, with the exception of some energy exporting countries in the Middle East and Africa, these are for the most part negative. So this is notably the case for the countries that are most economically integrated with Russia, and of course for Russia and Ukraine themselves for obvious reasons. But it is not exclusive to them. We see them in North and Central America. We see them in other African countries that are particularly vulnerable to inflationary effects. So this is a pretty widespread shock. It's what you should take away from this map. Also, as you may notice, even in Europe, which is a very affected region, there are some countries that are more affected than others. Most notably, when we're talking about major economies, we have the case of Germany and Italy, whose energy policy led them to be particularly dependent on the imports of notably Russian natural gas, and for whom, therefore, the diversification effects, the diversification strategies in terms of energy will be very crucial. And these efforts are underway. They have been substantial. We know of these construction of LNG ports in Germany. We know that Italy has been doing substantial efforts to increase their capacity to import gas, not only for Northern Africa. But these are projects that will have their desired effects in the time they take to have their desired effects is several years. So we know that towards the end of this year, when we go into winter, there will be most probably another period like the one that we had in recent months, where it is not evident whether Europe will be able to secure most notably natural gas supplies at prices that don't drive inflation up. So when we look at these actual growth forecasts year by year, if we examine this at the global level, well, the first thing to notice is that there is quite a substantial slowdown of the global economy after the remarkable rebound, post-pandemic rebound in 2021. So the global economy is still growing, but it is slowing at a very abrupt pace to the kinds of growth levels that basically we had in the years prior to the pandemic. Whereas at the start of the year, we were expecting something a lot more robust, a lot more optimistic. When we look at how these forecasts are for the major global economies, it is quite striking how quickly we are coming down to lower growth levels in Western Europe. This is of course mostly a consequence of inflation. We know that the very strong 8.1% level of inflation that we saw in the Eurozone, for instance, in the latest May figures, are having a noticeable effect on consumer optimism. We know that consumers are expecting to cut down on consumption in order to offset the effects of higher food prices, higher fuel prices, etc. So we are coming down to these lower growth rates quite rapidly. We should also underline that there are still positive growth rates. The economy is still growing. It is not, let's say, a more catastrophic scenario like the one we had during the global financial crisis or during the Eurozone crisis. But in Europe, we were counting on this higher than average growth during a couple of years to do things like financing the energy transition, to do things like improving just the overall capital stock and potential growth of the euro area. So this is quite an important disappointment. Also, it's important to underline, like I said earlier, the important growth revision in China. Looking at the trends that we are seeing recently in recent months in the commodities market, because as we know, this is the major factor fueling inflation, particularly in Europe. Well, after the very intense peaks that we saw after the outbreak of the war, we are seeing a certain level of stabilization. At least things in certain markets are looking like they are not getting worse. It is notably the case for metals. It is also the case for European natural gas, where markets are broadly assessing that the levels of gas stocks that have been reconstituted are sufficient, rather sufficient to get Europe through the summer. We should, however, underline that where like summer, of course, demand is very low compared to winter. We should underline that there is still these prices are still significantly above, you know, what we had pre-Ukraine war. Markets are still uncertain whether we're not going to have a crunch in during the next winter, and therefore are pricing this in. Unless we see further shocks during the rest of the year, we should normally start seeing this peak in these peaks in commodity prices translate further months below into peaks in inflation, meaning that we should see a certain moderation of inflation during the back half of the year. But this is, of course, subjected to several risks, notably the fact that, well, we should expect the Chinese economy, as it comes out of the very intense lockdowns that we've seen recently, to moderate, to rebound, and this of course will be seen in the prices of global commodities. But as globally, it's quite likely that we have seen the peaks in these markets, at least on the short term, in Q2. An important consequence about this inflation, of course, like I said, is the rising of interest rates, the policy interest rates that central banks are having to implement. And one important consequence of this is what we are seeing in sovereign debt markets, particularly in Europe. We are seeing a pretty broad-based increase on the yields, the interest rate that governments have to pay on their debt, and this can have some important consequences. Of course, we saw that this was the main factor in the Eurozone crisis that we saw between 2011 and 2013. We know that if the European economies were able to spend their way out of the pandemic, is because these refinancing costs were very, very low. And so it gave them a lot of the fact that these yields were very low gave them the fiscal space to do the interventions that they did. And so it follows that if these yields, because they are pricing in, you know, a higher inflation premium, but also because they are being affected by the rising of interest rates in central banks, if these yields continue going up, at some point it might start putting pressure on. It's going to start putting pressure on fiscal policies. It might force them to implement a little bit of austerity, or at least not be as supportive as they otherwise would be of the economy. And of course, in the worst case scenario, it might lead to a repeat of the euro crisis. Now, we hear a lot of these narratives in the media, but we think that there are reasons to believe that these scenarios often get overblown and are not as plausible as some might think. The first and foremost reason for this is that the European Central Bank, despite the fact that it is raising interest rates, has also reaffirmed its commitment to intervene in the sovereign bond market, like it has every time that sovereign yields go up. It will continue to buy bonds wherever it's necessary, whatever the spreads with the benchmark rate, which is the German rate, are getting too wide, and so we can be confident, I think, that that the ECB will not let this scenario materialize. On the other hand, we also must underline that even if these rates, it's what you see here on the graph on the right, even if these rates are rising quite sharply, we are still very much under the very far away of the levels that we saw during the Euro crisis, and even not as high as what we saw, for instance, in Italy in 2018, when there was the confrontation between the European Commission and the Salvini-Di Maio government over budgetary rules. So we're still at, I think, pretty reasonable levels of in terms of yields, even if the situation is deteriorating. So another key institution, other key institutions to look at is the attitude of commercial banks. We know that if during the pandemic we prevented essentially a wave of insolvencies, it was to a large degree because banks also were there to lend. You know, they were crucial participants of the loan guarantee programs that were implemented as a key measure to support firms. So it follows from this that a key factor to monitor, to think about the kind of pressure that we will see on firms is how the attitude of banks. One way to measure this in real time is to look at the European Central Bank's bank lending survey. This is a survey that the ECB conducts where they essentially ask banks whether they expect to implement more strict or more lenient lending standards over the next quarter. And what the latest edition of this quarter underlines is that an important percentage of banks, around 20% in the Eurozone average and also for Italy, are expecting to tighten financial conditions, to be more strict in how they lend in Q3. Sorry. We're definitely heading into an environment where banks are a lot more skeptical, especially regarding their more vulnerable clients. We should also take into account that this comes after a period where lending standards were broadly pretty lenient. So we are definitely, again, not seeing the kinds of tightenings of lending standards that we saw during the global financial crisis, during the Euro crisis. But if this trend continues to consolidate in the next few quarters, we should be very vigilant of what's going on with corporate liquidity, especially considering that also the demand for this liquidity is increasing as firms are seeing pressure on their working capital coming from reduced margins, of course, caused by increasing prices of inputs. So looking a little bit at we're going to look a little bit here to conclude at the two big engines of global growth, the United States and China. In the United States, of course, we saw this disappointing figures for Q1 GDP, but things are starting to look quite good for Q2. The numbers of the confidence indicators, especially for industry, actually improved in the May reading. We're also getting signs that the very tight labor market in the United States might be starting to loosen. Specifically, there is a survey conducted on small businesses where they are asked if they ask if they are having problems hiring labor, and in the January edition of the survey, 35% of small businesses said that this is a problem. This number was reduced to 23% in the May edition. Still, we know that the labor market in the United States was particularly tight. This is, of course, what is leading the Federal Reserve to do these 50 basis points hikes that are likely to continue in June and July. Nevertheless, a good feature of the U.S. economy is that corporate and household balance sheets improved a lot during the pandemic. You know, this is all these savings surpluses that were built during the pandemic. And so, despite what we've been seeing, for instance, in the corrections of the equity market recently, we think that balance sheets are in a relatively good position to absorb these rising of interest rates. Moving over to China, like I said, this is really, we have revised our growth forecast to 4.8. This is a number that is for 2022. This is a number that is substantially below the 6% target that the Chinese government considers like normal growth in China. We know that this is, for the most part, a consequence of these very harsh lockdowns that basically makes China, it looks like China is still in 2020 when it comes to COVID. We also have been seeing rising unemployment, deteriorating economic conditions. We also know that there is a dissatisfaction with inflation and with these policies in the population. One important consequence of this is that the Chinese government is going to have to basically put a pause on their cleanup of the construction and real estate sector that they had undergone during the past year. They are once again going to have to rely on rising construction, rising infrastructure, as they have historically, in order to limit the impacts of broader growth. And so these imbalances in the Chinese construction, these financial imbalances in the Chinese construction sector are going to continue. It will be very important also to monitor, of course, China's vulnerability to geopolitical risks, as we have seen in recent weeks, a further potential escalation of the rhetoric between China and the United States regarding Taiwan. Specifically, President Biden's assertion quite explicit that the United States would be considering defending Taiwan militarily in the case of an invasion. It is quite likely that the way that things have gone in Russia has given the Chinese authorities a lot of second thoughts about how well such an intervention might turn out for them. But this is, of course, a field that is very uncertain in geopolitics, as we know, and these indications of rising tensions are always should be looked at very closely. So with this, I end my presentation. I hand the floor, or Antonella, please, if you can hand the floor to Seltem.
Thank you very much for your presentation. Now we give the floor to Seltem. A lot of key takeaways, Marcos. Appreciation of dollars, stagflation, diversification is one of the key of our economy. And of course, we are also struggling in the increasing of price oil. So, Seltem, what is the situation of Middle East and Turkey? The floor is yours.
Thank you, Antonella. Thank you, Marcus. I think you can see my screen now, right? I will start the presentation with the GCC region. So we had already revised up our growth forecast for oil exporters in our April forecast period in line with rising energy prices. We now expect GDP growth of the GCC countries to accelerate from 2.6% last year to 6.3% this year. And this would allow the GCC countries to outpace many regions across the world that have been hit by rising energy prices. Consequently, majority of the GCC countries will actually surpass their pre-COVID GDP levels, except Kuwait that suffers from political gridlock that blocks the passage of a debt law and delay reforms. So, of course, behind this growth, key drivers will be strong rebound of oil production exports in the GCC region. This is a part of the OPEC Plus agreement, actually, and the group has decided to increase the size of its oil supply hike by 50% in early June, and now the group should add 648,000 barrels a day of oil to the market in July-August period, up from 432,000 barrels a day in recent months. So following a contraction of 5.4% in 2020 and the growth of 0.7% last year, GCC oil production is expected to rise by 10.5% this year, and higher production will be actually supported by mainly Aramco, Saudi Aramco, which awarded several important contracts, and also from the United Arab Emirates that targets to increase its oil production capacity to 5 million barrels per day by 2030 from current level of 3 million barrels a day. And also we expect the region's oil exports to rise by around 12% this year compared with last year. So on the other side, the non-oil economy will also remain resilient. The non-oil activity will benefit from high vaccination rates last year, which now allows a higher level of mobilization. The level of PMI across the region remained well above the 50 level that separates expansion from contraction. The spike in oil prices will result in a sustained economic activity thanks to a higher level of investments and capital spending from the corporate side. For now, the surveys show that consumer demand is responding well to price increases as new orders continue to rise, leading to a robust expansion in the business activity. However, inflationary pressures will continue to increase mainly on higher fuel and raw material prices. Inflation will come above its long-term trend, but this will affect household spending only moderately. Under a fiscal point of view, higher oil prices are expected to feed through higher government revenues. This will improve the fiscal position of many GCC countries. Actually, all the GCC countries are expected to record a budget surplus, except Bahrain, which is expected to record a deficit of around 3.5% of its GDP this year. And because of previous fiscal deficits, we expect the fiscal prudence will remain in place in the region, especially for Bahrain and Oman, which are the weakest link of the region in terms of fiscal balances. For example, Oman said it will use its oil revenues to reduce its public debt to below 20 billion riyals. So it means that higher oil prices will not necessarily increase the budget surpluses, but a part of it will be used to pay back the debt, or at least reduce the level of debt stock. Well, coming to Israel, we expect Israeli growth to stand at 4% this year after recording a rise of about 8% last year. In May, the central bank hiked its policy rate from 0.35% to 0.75%, citing elevated inflation and solid growth environment. The decision followed the previous hike of 20 basis points in March. The bank additional rate hikes of between 0.75 to 1% on the back of higher inflationary pressures. The average annual inflation in Israel can reach 3.5% this year, compared with 1.5% in 2021. On the back of elevated commodity prices and also a higher level of prices in the housing sector, as well as a strong wage growth in the ICT sector. The economy actually contracted in the first quarter at an annualized 1.6% compared with the prior 3 months, led by declines in exports and consumer and government spending. In the rest of the year, growth may lose some momentum, as signaled by some high frequency data, as you can see in the second chart, and also with the PMI. Actually, PMI scores remained well below 50 level in the first quarter, and low jobless rates will support household spending, but higher financing costs may weigh on the investment side of the economy. Coming to Turkey, Turkey posted strong growth of 7.3% in the first quarter of this year on the back of a jump in private consumption and positive impact coming from the net export side. We expect this impact to fade away in the remaining part of the year because of high inflation and jump in energy prices. Well, industrial production has started to lose some momentum. In March, on a seasonal and adjusted basis, the monthly data show that industrial production contracted by around 2%. And on an annual basis, the pace of growth of manufacturing production slowed to 10.6% from around 40%. And the PMI data also witnessed the same trend. And for 3 months in a row, the PMI data show that the operational conditions in the Turkish business sector have deteriorated. As you can see in the second chart, there is a clear widening trend in the current account deficit that we expect to reach 3.5% of GDP this year, compared with our previous initial forecast of 1.5%. Turkey's energy imports widened to $24 billion in the first quarter, compared with $9 billion in the same quarter of a year earlier. Consequently, even if exports keep their rising stance, it seems that export revenues and tourism revenues will not be enough to reduce the current account deficit widening. On the inflation side, we expect the annual inflation to rise to 75% in Turkey, compared with our initial forecast of 48%. The central bank low policy stance results in a fast deterioration in inflation expectations, which in turn feeds through upward price pressures. We expect the central bank to keep flat its policy rates in the remainder of 2022, while more macroprudential measures can be used to increase liraization policy. Supply shortages and the lira's weakness would support upward trend in the producer prices. So inflation would be more stickier than the central bank's expectations. Additionally, wage increases will continue to put upward pressures in production costs. In April, services producer prices rose 83% from a year earlier, while hourly labor costs increased around 50% in the first quarter of this year. This indicates that price dynamics have entered salary discussions throughout the economy. So as a result, persistent inflation and potential price spirals may be difficult to avoid in the economy unless there is a tightening of the monetary policy. A lack of tightening of the monetary policy may contribute to an upward revision of our end-year average inflation forecasts further, in line with the lira's weakness and rising producer prices. So thank you so much for your attention. Now I'm going to leave the floor back to Antonella.
Thank you very much for your presentation. And now we have the view from Aroni of the situation in Africa. Thank you very much.
Do I have the screen? Yes, I have the screen. So yes, good morning, everyone. Now we're going to look at what's going to happen in Africa. But before that, let's jump back a bit on what Marcos was saying and about what's happening in the US, because that has a direct effect on African economies. So we all know it by now. I mean, the US is going to front load its monetary policy tightening, and with rate hikes, which will bring the rate to basically 2.75% at the end of the year. And so that obviously, and you can see it on the chart on the left, is creating capital outflows. And actually here there's a double effect. There is the effect that obviously the US interest rates are higher, so there's incentive for investors to move back to safe US assets. But there's also a second geopolitical reason, is that we are in an uncertain environment, and that in any case more risk averse investors are going to be encouraged also to send back assets to safer markets like the US. And so that is why, with this double effect, we have a risk reward that is largely in favor of the US dollar, and which is why we can see that the US dollar has appreciated, and which, as Marcos said, is creating depreciation on all other currencies. Now, the real question for Africa and for African economists is basically how do monetary authorities react to this? Because we have seen that there have been several central banks, including the SARB, the South African Central Bank, and others on the continent, who have already started to hike rates, sometimes even at the same extent than the Fed. But when you're tightening your monetary policy, you're also creating a slowdown of your economy. So there is also a question to be asked of which economies have the more room for maneuver in terms of monetary policy, considering what the Fed is doing. And also that will depend on how their currency will fare in an inflationary environment. So basically, you don't want additional imported inflation because your currency is becoming weaker versus the USD in an environment where food and energy prices are already high, on which African countries depend a lot. So one way to look at this issue, and in order to identify which countries are potentially weaker in this environment of monetary tightening, is to look at the current account balances. So current account balances are, the phenomenons within current account balances are quite complex. So we're really going to stay at the surface level, but this already gives us a lot of indication. So we already see that most African countries are in a current account deficit, and this is not surprising, because actually, low income and developing economies, their growth driver, their growth driving system is to bolster growth by public investments through a lot of imports, because they want to build infrastructure, they want to improve the business environment. So ultimately, running structural current account deficits, it is not necessarily a bad thing in terms of growth. However, it does weaken the external position of your economy. And in the current environment, it is countries which have surpluses which are in a better position, because the current account balance is basically the major component remains the balance of trade, and the balance of trade gives you, terms of trade gives you the strength of your currency. And so we can see on the right of the chart that basically countries that are commodity exporters have the current account surpluses, and hence have stronger currencies in this current environment, and hence will have a bit more leeway in terms of monetary policy than all of the countries that are on the left of the chart, which are running current account deficits, which are more at risk. And then there's also the question, when you talk about current account balances, is how do you finance it? Basically, it's you finance it via FDI or you finance it via borrowing. And there is another question of, for all of the countries which are used to finance this current account deficit by borrowing, which are smaller countries and mainly on concessional loans, but also on private loans, for them the situation is more concerning, because financing conditions are becoming tighter because of the current environment of high interest rates. So for countries typically like Rwanda, or even like Senegal, or like Uganda, or for Tunisia, this is where the issue comes, because their policy of using borrowing to finance these deficits is going to be much more complicated. Here we have one case that I would like to talk about, because it's like a very special case. You can see, I don't know if you can see here, but basically the scale has been broken, because Malawi, which is around a current account deficit of around 17% of GDP, and then the next one is Mozambique, which is basically 45%. But Mozambique typically is not a country which is considered as having a weak external position, and it's because this massive current account deficit is on the back of the development of LNG mega products. So here there is a concept that we call inter-temporal trade, which is basically that Mozambique is running current account deficits now in order to create an industry that will generate surplus in the middle to long term by LNG exports, and which is, we'll see a bit later, which is one of the strengths of some of these African countries. So here we also have a case where Mozambique's currency, for instance, or even the Mozambique central bank isn't necessarily in a weak position because of its high deficit. So that I wanted to have this more extreme case to explain that everything is not straightforward, but generally speaking, countries running structural deficit are more at risk right now. So how does this, this high commodity prices and this monetary policy of the Fed and the depreciation of currencies, which it entails, affect inflation? So obviously we always have a lag in Africa of 1 or 2 months, but we do have the inflation readings for the month of April. And on the right-hand chart, I've also shown you basically how the CPI basket of this is the 6 major African economies is composed. Normally you can have core, non-core, you can have food and energy, non-energy. I mean, you can basically break down the CPI basket in different ways. I thought that since the calculation methods of the central banks of these countries were not the same, I would use what the IMF uses in terms of weight, which is basically food, utilities, transport, which are in Africa, which are the main components of the consumption basket, and then all of the other components. So you can see that, for instance, for Nigeria and Angola and Algeria, the food component is very high. In South Africa, it is more so the utilities, so the energy price, which is included in that, which is important, as well as transport. In Egypt, it's a bit of both. In Morocco, it's mainly food. But how this translates in the inflation rate? Well, we can see that most of the inflation rates are increasing, but they're not increasing at the same to the same extent or at the same strength. Egypt's inflation is the one that increased the most. It's because food is a very important component in Egypt's basket, mainly wheat. So we have already talked about this many times, that Egypt being the main wheat importer for Russia, they had big price pressures on their food imports, but it's also because the Egyptian government let the Egyptian pound depreciate quite a lot, and that's also reflected in this steep inflation rate. Whereas for Morocco, it's also quite high, the inflation, but it's not as steep as in Egypt. And then it's more stable in Algeria, because in Algeria has food inflation is important in Algeria, but they have much less energy inflation. And in South Africa, it's more stable, although it's increasing, because South Africa's inflation is more anchored to the core, and that's why the increase is not that steep. Same thing for Nigeria, which has already a very high inflation rate because of food. it's starting to increase, and it will increase more because of the weight of food. The only inflation where we have a decrease in the inflation rate, a slowdown in inflation, is in Angola, and I think that this is the very interesting part. And why is this? Despite the fact that Angola does have a very high food inflation and is a net importer of food, it's because of what we talked before. It's because the Angolan, the Kwanza, is appreciating because of the demand for Angola's oil, which basically reflects, the strong trade balance, the strong current account surplus, and the strong terms of trade of Angola. So even in a very inflationary environment, you have countries in Africa, and typically they're the commodity exporters, which have which have inflation rates that can be stable or that can even decrease because their currencies are strong, because there is demand for their products. So, for instance, it's the same thing in Zambia. So overall, obviously, inflation is increasing in Africa, but there are different dynamics and largely dependent on the position of the country as a commodity importer or exporter. Now, if we look at growth, and here we have actually compiled the overall GDP growth rate for Africa, which means including North Africa and Sub-Saharan Africa, we can see that the post-pandemic rebound was strong, but that there is a slowdown like in the other regions of the world for 2022 and for 2023, because higher inflationary pressures, contraction of household consumption, and slowdown in the main export markets, because Africa is very dependent on its export markets, namely China, Europe, and the United States, as well as the Middle East. One very important thing to note is that despite this rebound, first of all, the drop of 2% in 2020 is actually met by a drop of 4.5% of GDP per capita. So we always have to keep in mind that Africa's population growth rate is around 2.7% per year, and it's going to be that between now and 2050, which is why the population in Africa is going to be around 2.5 billion in 2050. So basically a 3.8% growth rate is actually very sluggish for Africa because its population is growing so fast. So while we still have positive growth and we do have a certain growth dynamic on the continent, in terms of poverty, in terms of income, in terms of standards of living, it's still very much stagnating, and that is one of the issues regarding Africa in the more medium to long term. And it's obviously there's also another thing that has to be said, that Africa's overall growth rate is very heavily influenced by the growth of its heavyweights, which are Nigeria, Egypt, and South Africa mainly. So here, as you can see, for the 10 largest African economies, South Africa is going to return to its sluggish growth pace in the medium term in 2023. The real surprise here would be, or the real very positive development here would be Angola, which basically had recessions for 5 or 6 years, and now is in positive growth territory since 2021, and will continue growing because the fiscal consolidation that Angola had been doing is now bearing some of its fruits, and obviously a very high hydrocarbon prices. So it's quite a big rebound for the Angolan economy. It's a bit the same with Zambia. Whereas in Nigeria, I mean, you're going to have there is, after the rebound, I mean, there is still going to be growth. The country will benefit from oil prices from the point that the Dangote refinery is online, and they'll be less reliant on the imports of petroleum products. For Egypt, growth is still going to be strong because it will be, and despite the prices of food and the high inflation, because there's still going to be a lot of public investment, including in the gas sector, and also for the development of the East Cairo capital, I think. And also because of Egypt's very geostrategic position in the Mediterranean. If something goes wrong, the country will be helped by all of its international allies. And I think that just to end with these growth prospects, it's important to talk about this, these frontier markets. I mean, Ethiopia is not yet a frontier market, but Tanzania, Kenya, and Ghana are frontier markets, which will continue to do very well. There will be a slowdown after the big rebound, but they'll continue to have consistently strong growth rate. And this is because these economies typically have a growing domestic consumption, a growing middle class. They have strong public infrastructure investments in many projects, and basically they're quite dynamic economies, which also, well, Ghana's debt situation is a bit concerning, and that's also why the CD depreciated quite a lot, because investor confidence is not very high. But generally speaking, their debt dynamics remain sustainable. So they kind of showcase the part of sub-Saharan Africa which is very dynamic and which has got very strong growth. So it's important also to show that these countries will keep doing well despite these headwinds, because their economic structure is quite solid even in these uncertain times. Now, just to end, and I want to do a little less of big macroeconomics and concentrate more on now two subjects that are very specific to Africa. I get asked the question a lot right now about what about these countries that have hydrocarbon reserves, because Europe has realized that it still needed fossil fuels, and that it's particularly needed natural gas after the Russia-Ukraine war, and has been looking towards Africa because Africa has got large proven reserves of natural gas and of oil. So now the question is, for the countries which do have these resources, how will they benefit, and when will they benefit from these resources? So I've on this chart, I've done the life cycle basically of an oil and gas project. I mean, between oil and gas, they divert a bit, but this is basically synthetic, just to show you the time it takes between exploration and the end of production. And so basically you have 5 phases. You have discovery, evaluation, which is the exploration phase, and then in what we call the production phase, you have development, production, and abandonment is when you close the well. And really the two main parts where we'll be focusing is this development and production phase. Because for countries which are entering the production phase, they will be able to benefit quite fast from the high prices of oil and gas due to the current situation. So here we have Mozambique, if Coral South goes online when it is scheduled. We have Senegal and Mauritania. We have Ghana as well, which was already in 2016, but which is now operational. So these countries will benefit in the short term from these prices. But then you have other countries which are in the development phase, and you can see that this development phase can take from 1 to 5 years, so the timeline is actually quite long. And in these cases, it's a bit more uncertain, because if the development phase takes 1 year, then it is possible that production starts in 2023 or 2024, and that these countries will benefit from the prices. But if it takes longer than expected, and which is possible because you can always have issues regarding this development phase, regarding the final investment decisions, regarding the negotiations between governments and the oil companies. So there can be delays, and there has been. I mean, for instance, Ghana here now is in production, but there was considerable delays in these projects with too low oil. So when you're in this development phase, I mean, eventually you're going to get there where you're going to produce, but then are you really going to reap the rewards of high prices or of European demand for gas, which seems to be the step that Europe wants to take right now? But will it be the case in 5 years? We don't know. So in those cases, well, it's a bit more uncertain, although these projects will eventually come online. So for instance, Uganda and Tanzania for the oil fields and the associated pipeline that will take the oil from Uganda to Tanga in Tanzania, or even the Trans-Saharan gas pipeline, so which is from Nigeria to Algeria. So these big projects, will they eventually come online when gas prices are still high? That remains to be seen. And there are also a lot of risks associated because it's Africa, and because Africa has got structural security and geopolitical risks. So for instance, in Uganda and Tanzania, there's now a big environmental battle around the Kingfisher oil fields because it's near Lake Albert. There's a lot of biodiversity, and you have environmentalists who are battling basically Total and the Chinese oil company who are in the exploitation of these fields. And you have even some big bank and insurance companies who are starting to pull out of the project because it is not in line with their ESG standards. So these are questions that can come and hamper the development of these projects. So that is why it's important to keep in mind where a country stands.
Let's go to the conclusion.
Yeah. So finally, I'll just end very quickly on climate risk because I just talked about oil before. So basically, this is our in-house climate risk indicator. It measures the physical risk, so the exposure that a country has to climate events, and then the sensitivity of an economy to these climate risks. Basically, if agriculture is important, how developed is the urban area, how important is the rural workforce, etc. And so for climate risk, you can clearly see here that Africa is the most exposed continent, whereas it is also the continent that has the less carbon emissions per capita over the globe. And so basically this calls into question, this will be kind of the question coming in a new future, because the next COP27 is in Sharm el-Sheikh, is in Egypt. So the place that Africa holds in these climate questions, and especially because Western countries are looking towards this continent for hydrocarbon reserves, will be very important, and that is why we try to measure how these risks impact the African countries, and this is kind of the question we'll be working on in the near future. I'm done. I'll give back Antonella the control so we can go in the Q&A.
Thank you very much. Thank you to all our economists for this really interesting outlook on geopolitical, also uncertain situation. Now it's time for question. I ask to close your presentation, Aroni, and I will start with Marcos. Marcos. We have now more than 100 days of war. What will be the long-term consequence of the war in Ukraine, in your opinion?
Okay, yeah, it's worth asking because we didn't say it, but as you may have noticed, all these figures that we give in these webinars, they're relatively short term. You know, it's what we can measure, really. You know, these forecasts are 1 year, maybe 2 years at the most. On a more long-term structural perspective, well, there are kind of like two effects that come to mind. The first is this discussion you may have heard about on what is being called friendshoring. You know, first you had nearshoring, now you have friendshoring, and the idea behind friendshoring is that to the extent that you will be realigning and reorganizing supply chains, well, the fact that you saw that being very integrated with a potentially hostile, politically hostile economy like Russia is giving you a large amount of exposure in terms of your supply risk exposure, in terms of your sourcing, in terms of you know, inflation and everything. So the corollary is that you are going to be wanting to restructure your trade flows, your trade and financial flows with countries on which you can quote unquote rely, countries that have a similar institutional preferences. And we saw that you know, this is this kind of like geopolitical risks are really putting into light the extent to, you know, what are the blocks on the geopolitical arena. If we think, for instance, about the vote on the UN assemblies to condemn the Russian action, we really saw like a very clear like Western democracies bloc emerge. We saw that emerging countries, even ones that we don't necessarily think of as hostile, that we may even think of as relatively friendly to Western democracies, such as India, like they were a lot more reticent to outright condemn, you know, what's happening in the war. So what does this mean? This means that if Western democracies, if Western countries actually do this friendshoring, well, you're going to have integration that is happening a lot more between developed economies rather than between developed economies and developing economies. And all other things equal, this should be on the low over the medium to long term inflationary. Why? Because if you're integrating between developed economies, you're integrating between economies that have high labor costs. And why do we have disinflation? Why did we have lowering costs of goods and products during 30 years before right now? Is because we got integrated with China, and China was a very low cost country for manufacturing. And it's also worth mentioning that it's not completely clear. I mean, it will be determined whether such friendshoring would actually be will actually allow you to be more independent in terms of your sovereignty, in terms of your sourcing. Because if I take an example, you guys know that there's a baby formula shortage in the United States. Baby formula in the United States is mostly, I think, almost overwhelmingly produced nationally, because it's considered to be some kind of strategic commodity, safety commodity. And all these shortages in the United States are being caused by supply chain disruption at one big factory. So companies are really going to have to think about whether these reorientations that in their heads are being made to strengthen resilience are actually strengthening resilience. The other important consequence, namely more specifically for Europe of the war, is what we call the end of the peace dividend. And what we call by the peace dividend is the fact that European governments have been able to very much reduce their spending on their military spending because of reliance of NATO, because of the because of this very long disappearance of war from the European continent, and they have been able to use those resources, those tax revenues, to invest in education, technology, whatever, infrastructure, all these economically reliable and profitable investments. We see that that trend is reversing. We see that Europeans will have to be taking their security concerns, their defense concerns a lot more seriously, and therefore this is yet another element that might increase the pressure on finances in the European continent.
Thank you, Marcos.
With this, I'm going to have to leave you guys. But thank you for attending the presentation, and always we'll meet you for the next webinar. Ciao, ciao.
Thank you very much for your presentation and your highlights. Seltem, let's go again to Turkey. Turkey is always struggling with inflation. Where do you see Turkey inflation to peak and when?
Well, if you'd asked me this question a month earlier, I would say that we were expecting the inflation to peak during the summer, but last month, at the end of May, we got new price increases in natural gas and electricity, so this has changed slightly the outlook. Now we expect the inflation to peak at the end of summer and maybe early in September, and well, the new peak can be somewhere between 85 to 90%. So we believe that, of course, the trend in inflation will be related to the pricing behaviors of the companies, but also to the external factors related to the commodity prices. But as you saw in the presentation now, because of skyrocketing inflation pressures, there is a wage spiral in the economy as well. So compared with a year earlier in the first quarter, unit labor costs increased 15%, which is quite impressive. And in July, chances are high for a renewed increase in the minimum wage. So if this happens, this will also add to the inflation. And that's why actually we increased our end year actually average inflation forecast for Turkey to 75%. So we expect the peak to be somewhere between 85 to 90% and towards the end of the summer.
Thank you very much. And the latest question is for Aroni. Aroni, if let's go to the population of Africa. If we believe governments will take necessary measure to alleviate the last expensive food and energy of their population, with the aim to reduce the social risk, where will they find the means?
I mean, it all depends on which country we're in. I mean, like in the first place, there are many governments who have already taken measures for food and energy prices because they had to. Honestly, the reason is that in order to maintain social stability, governments have to take actions in these kinds of environment where you have an increase in the price of necessities, because there are big vectors of social frustration. So the question remains, what resources does a country have in order to implement these subsidies? And part of the answer lies in the same thing as in kind of the same concept that we were talking about when we were talking about the current accounts, is that basically countries which have commodities and which can generate fiscal revenues from commodity exports have a natural and a massive advantage right now in terms of having the fiscal space to implement the subsidies and to support their populations in a time of rising food and energy prices. Now, for countries which do not have that kind of an advantage, well, it depends on the fiscal space. It depends on how strong, first of all, their domestic growth has been, because that is also where you generate fiscal revenue. So if there has been a strong rebound in 2021, you will have your deficits will not have disappeared, but they'll have shrank. You'll have generated a bit more fiscal space. So if you have strong growth, you also have a bit more space in order to implement these measures. And for countries which have neither of those of commodity exports for fiscal revenues or strong growth, strong enough growth to generate enough fiscal revenue for the subsidies, well, you have to borrow, and that's where the real risk is. So for countries who will have to borrow more in order to finance the subsidies, it's a problem, because one, as I said, we are in an environment where interest rates are higher, the cost of borrowing is higher, and there's also the perception of creditors of these economies, which can sometimes have twin deficits, so current account deficits and fiscal deficits. So the perception deteriorates and the financing costs become higher. So for these countries, it will really be more of if the international community and the international organizations are still willing to give support to these countries, especially in terms of humanitarian help for food. So we have seen that the UN food programs, they've started working on how to alleviate some of the pressures. We know that the IMF is ready to extend additional measures for countries which need them, especially if we see in the cases, for instance, of Tunisia or Egypt, which are also important geostrategic countries, but also for countries in sub-Saharan Africa. So there are a lot of countries in Africa which will still need international help. And I think that it will be critical to see how the international organizations respond, and also what conditions they will put forward for this help, because the help from international organizations also come under certain conditions, under certain rules that the economies have to respect. So under what conditions they will accept to extend this help, I think that will be fundamental and also for the debt trajectories of the continent.
And to close, of course, the situation between Russia and Ukraine doesn't help at all. Anyway, no. I really thank you, our economist, for the interesting and important update. I thank you all, the participants. I remind you all that you will receive the presentation and the recorded version of this webinar. And we invite all of you to follow us on our social media, to follow our publication on our website, and we will have another webinar in the autumn. So I will invite you again. And thank you very much. We close the webinar now. Thank you, Aroni. Thank you, Seltem. Bye bye.
Thank you. Bye bye. Bye.